The Federal Reserve announced yesterday that it would drop interest rates by 0.5 percentage point. Here's what this means for people who want to buy a home or sell a home, people who are worried about the cost of groceries or the returns on their retirement. The Federal Reserve is aiming to do something that historically is very, very hard to do, and that is engineer a soft landing. A soft landing means that they've brought inflation down without causing a recession. And right now, yesterday's decision is close as we get to a declaration of victory. Inflation has come down and we have no recession. Now, whether the recession is coming is a different question, but this 50 basis point cut is their indication that they're now taking recession risk very, very seriously. Inflation they're less worried about, recession is their primary concern. We're going to see interest rates start to drop in time all over, from mortgage rates to also rates that you'll be paid, depositors are paid at banks. This means it's becoming a better time to buy homes than it has been in the past, but it's also a time when people are going to be leaving less money inside their bank accounts as those returns start to come down.
Yesterday's rate cut did not come as a surprise to the financial markets. I would argue that the markets have expected a 50 basis point cut for a while, and there were arguments from certain market followers. Our colleague Jeremy Siegel has in fact advocated for a 75 basis point cut earlier, and he said recently he's happy that the Fed went with a 50 basis point cut. I must say that many economists actually did not expect such a large cut. The FT-IGM survey of US macroeconomists that came out a few days ago had 95% of the participants predicting a cut of 25 basis points or less. I'll brag that I was one of the 2 people on the survey who said that there would be a 50 basis points cut, and my view was based largely on the fact that the bond markets seem to be consistent with the behavior of the Fed funds rate in light of the recent inflation and unemployment numbers. That would indicate a 50 basis point cut at least. But I did not think the Fed would go beyond the 50 basis points because that would risk perhaps creating a bit of a panic in the financial markets. Now, why would the Fed cut by 50 basis points given that the goal of inflation under 2% has not been achieved? That's because there have been recent tremors in the real economy. Employment has not grown as fast as some expected. Unemployment has been ticking up ever so slightly. And that is always a sign that the real economy is slowing and employment is potentially presenting risks, which is what Jay Powell indicated in his press conference yesterday. Does it mean that we are heading for a recession? Well, certainly the Fed wants to avoid that. And I think some of the reaction of the markets yesterday to the positive surprise of a rate cut was mixed, precisely because it indicates that the Fed is perhaps more concerned about a recession that many have anticipated. Now, today's, again, market reaction is consistent again with this is good news. We can engineer a soft landing, and things are as good as it can be given the situation. Some still worry that the Fed is cutting too much too soon, given that inflation is still well above 2% and might not slow as fast as we want. Again, the Fed sees risks now more on the downside for employment than inflation. Let's hope they're right.
For more insight from Knowledge at Wharton, please visit knowledge.wharton.upenn.edu.